What's up everyone, Dylan here. I wanted to hop on for another episode of the weekly analysis video. With that said, we'll hop right into it. The bulls remain resilient as NASDAQ is now seen up over 30% in the last 6 weeks, which is extremely impressive. Plus, this comes after Moody's downgrade of US credit rating from AAA to AA1 Friday after the close. I saw a lot of people on Twitter over the weekend saying how this was very, very negative for the market and that the market pullback was inevitable. People were saying that Monday was going to be limit down and all this fear mongering stuff, right? Let's talk about that. So it's very, very important to note that Moody's was the third and final credit agency to do that downgrade, right? Fitch downgraded from AAA in August of 2023, and the S&P cut all the way back in August of 2011. So again, this is the third and final one, which was basically inevitable, right? It was basically bound to happen because since the 2011 credit downgrade and the August of 2023 downgrade, the U.S. debt has continued to surge. So again, it was no surprise per se. Okay, so that's one thing. So what does this mean? I'm gonna give credit to Aisha Tariq. She put it very, very clear and concise. They wrote, as the credit rating falls, it indicates a higher level of credit risk for the country's sovereign debt or treasuries. In this case, the country is in a worse off situation to repay its debt. This means that investors demand a higher premium, for example, a higher return for taking on that additional risk. Therefore, yields should move higher. Okay, so that's the general idea of what this causes. Okay, however, if we look at the US 30-year, okay, you could see that it hit 5%, which has been basically you can argue that this looks like a triple top, right? It hit 5% early on in 2025, this year on January 10th. It also tested 5% April 9th, and then again this morning on May 19th. Okay, so this is the third time it has been up to that 5% level. The one thing I will say is if it does get above there and sustains value, okay, and really pushes to the upside, it can act as a headwind for the overall market, okay? But as long as it continues to fail there, it can act as a tailwind for the market, which is essentially can be a nice relief for the overall market. Okay, let's talk about TLT. Okay, so TLT represents the 20-year Treasury bond ETF. Essentially, this has an inverse effect as the Treasury note yield, right? U.S. 30-year, U.S. 10-year, or TNX is the index to show the 10-year rates. Okay, so TLT, when TLT goes down, TNX goes up, and vice versa. Okay, TLT has the biggest short underway in the last 15 years. The short flow is 24%. Okay, short positions in TLT, which is the popular 20-year US Treasury bond ETF, have spiked to over 130 million shares, up from 107 million last month. Okay, so it's a very, very, very crowded short, right? I have a picture from Subu Trade. You can see this is the price of TLT in the blue, and then the short interest in the black. The short interest, again, is the biggest short in over 15 years. So a lot of speculators are betting that TLT is going to continue to the downside. However, when you have a very, very, very crowded trade, it doesn't take much to flip that sentiment, right? Famous quote saying, if everyone's on one side of the boat, you probably should go over to the other side to save yourself, right? Because when something gets way too crowded, usually the opposite occurs as you know, too many people are on one side. Okay, so being that TLT is at a key support at 85, right? This was a gap fill from November of 2023, and also a triple bottom similar to the triple top that I just showed you in the 30-year yield, right? Technically, what I'm saying is more chances than not, TLT is going to bounce. Okay, and if TLT does bounce, the yields will come off, and in theory should act as a tailwind for the overall equity market. Okay, so yes, Moody's downgrade should move yields higher as those investors demand a higher yield premium for taking, more risk, in terms of investing in these bonds. However, because the bonds are so short, right? The speculators in the bonds are so short, it wouldn't surprise me for bonds to bounce from here and as a result pull the yields down. Okay, that's just a guess. Full transparency, I am not positioned in this trade that I'm going over. Okay, so again, too many folks being short TLT can act as a recipe for a short squeeze to the upside, driving down yields. Okay, and this brings me back to what we talked about in the S&P last week. Right, last week's video posted last Monday, I went over how way too many people were short, and that it was a very big benefit for the market bulls, as you know, speculators that are underweight stocks and that are short set up for a recipe for folks to chase longs and stop out of shorts. So let me go to the Discord, right? You could see here, this is what I showed you guys last week, right? With resilient U.S. macroeconomic data powering a continued rebound in U.S. equities, non-dealers sold S&P 500 futures, right? The COT covering flows from April 29th to May 6th exhibited $17.1 billion of net non-dealer net selling, right? Then I went on to show this as well, right? Post from Goldman Sachs Prime Brokerage Desk confirming what I talked about last week. Some crazy stats showing the caliber of the pain experienced by shorts right now. Despite the S&P rallying higher over the past 5 weeks, people have been selling and shorting. This results in an increasing amount of shorts and funds who are very underweight in equity holdings, which can result in the market squeezing higher as those folks cover out of the shorts and or chase the market higher to increase portfolio weighting. Okay, so global equities saw the second largest net buying in 5 years. Buyers significantly driven by short covers, right? So very clear. What I talked about last week is coming into effect, right? So after 9 consecutive up days here, right, followed by a nice basing period, we are now at 6 consecutive green days. So without any argument, the bulls remain very resilient, and the positioning has been very violent from short to long, right? Here's from also from the prime brokerage Goldman trading desk. U.S. equities saw the largest net buying since December of 2021, driven by short covers and to a lesser extent long buys, suggesting that hedge funds were stopped in amid the market rally post a U.S. and China trade deal. So a lot of folks were short, and then following that trade deal, they were chasing longs to the upside, which fueled the market higher and higher. Okay, so that is still a threat to the sellers in this market. The fact that a lot of folks are short. Now, relative to last week, the short interest on the S&P has declined, as I just showed you guys that positioning has flipped from short to long as folks have chased this move higher. Okay, out of FOMO and out of the fact that they have to put some extra weight on their underweight holdings. Okay, so where does that bring us? That brings us to the level that I wanted to talk about, or that I talked about last week. Let's go there first. So the level I talked about last week was 58.50 to 58.51. Okay, so 58.50 to 58.51 marks the area of that has been a key inflection point since last year. Okay, just wanted to briefly make that note, and then 200-day moving average also lined up with that general area. Okay, so let's go back here. I also talked about last week how I was looking to potentially get long on the VIX, and then the following day after that video, I said I did not enter that trade as it occurred at 12:30 a.m. Eastern time. I was asleep, but I said I'm keeping an eye on ES relative to yesterday's highs, where the 200-day moving average lines up. Above there, bulls have complete control, and that still stands. So when I posted the last video, we were on this day. So it had come up to that 200-day moving average and that key inflection area over the last year. And then the very next day broke above that. And then you could see ever since breaking above that on Tuesday, every single dip has been bought above the 200-day moving average and that 58.50 to 58.60 inflection point. Okay, so over the last week, the bulls remained in control ever since they took out that 58.50 to 58.60, as the resilience is very, very, very apparent. So going forward, I want to keep an eye on this level here, as it has been a short-term pivotal area. Okay, what do I mean by that? Last Tuesday and Wednesday, it acted as resistance, and then you could see Thursday, it acted as support there, and then Friday got down there as well. If we move this up a little bit, you could see Friday also bounced there. So that line lines up right with 59.25, right? Previous resistance, and then it turned into support Thursday and Friday. Okay, then with the Moody's downgrade, it moved below there, bounced again Sunday night, right, last night on the reopens for Globex, and then came back below, only to the bulls to get back above there as well. So going forward, very, very short term, I would look at 5925. The bulls do not want to give that up. Okay, if the bulls give that up, and then you see that sellers keep a lid on price rallies back into that 59.25, and they reject that area, I think the next level down is that 58.60 and 58.50, as well as that 200-day moving average, which lines up with that. And again, as long as price remains above 58.50, 58.60, and that 200-day moving average, the bulls technically have control, which implies that the dips are more likely to get bought. Okay, so that stands. To the upside, there's a very, very important level on the NASDAQ. The NASDAQ has a very, very clean trend line stemming all the way back from October 1st of 2024. Okay, let's draw that. I'm going to draw it two different ways so that everyone is happy, right? We could go, I'm going to clone this and then draw it right there as well, so we could get more wicks involved. Okay, so this general area has acted as support numerous times, right, all the way back from October of 2024, and you could see multiple 1, 2, 3, 4 different 5 different tests at support, and then once it broke down in February, right, February 27th of this year, it kind of retested that general area, but now it is coming back up there as again. And at the same time, the RSI is at overbought territory. So technically, what that implies is that an extended move into a key resistance area has a higher probability of rejecting. Now, does that mean it has 100% probability of rejecting there? No. But in terms of pure probabilities, it has a higher chance of rejecting there when it is overbought on key time frames after an extended move, aka 30% in the last 6 weeks. So am I positioned for a short right now? No, but I am actively looking at that area that I just made. Okay, so to the downside, again, S&P 5925, and then if that breaches below and sellers continue to defend that general area, I think the next level down is that 200-day moving average, which aligns with 5860 and 5850. To the upside, NASDAQ trend line, which sits right at, call it 21,610 to 21,670-ish. So that 60-point area, I'm going to have a very, very close eye on to kind of gauge relative strength and weakness, okay? If the NASDAQ breaks above there and sustains value, guess what? The bulls remain resilient. If they struggle there and that overbought signal continues, then I would imagine that the S&P and the NASDAQ are going to pull back to then test that blue line on the S&P, and then maybe these two black lines if that blue line fails to hold. In terms of individual equities, I closed out of the Tesla calls that I went over. This ended up being a very, very solid trade. So I'm glad I caught some of the upside that we've been seeing in the market. Despite me not catching it necessarily in the S&P and the NASDAQ, I caught it via Tesla. I got into those at $7.80, and my best fill to the upside was $50. So very, very good return there. In terms of United Healthcare, I also took a trade on this, right? This thing has been getting clobbered. Multiple reasons. Ever since the CEO got murdered, right? Then the new CEO stepped down out of nowhere. And then above that, or beyond that, they had a report from the DOJ, an investigation as well. So numerous times this thing has been clobbered with bad news, but it was down over 60% within 5 weeks, which is nuts, absolutely nuts to see from a mega cap name, a top 10 name in the Dow Jones, which is supposed to be a value name, right? If we look at the price to earnings ratio, this thing almost hit single digits. It got all the way down to right around 11.5, right? That does not happen, right? This was the lowest valuation that it had since, let's see, lowest valuation since 2013, so over a decade of the lowest valuation, which again, a top 5 mega cap name, usually that acts as a very, very solid sign to get long. I did get long this thing, but unfortunately I mistimed it and stopped out. I was posting that in the Academy. Right, we go, right. So I got in for an average gain or average entry of 284.38, and then I stopped out below 260 for a realized loss of 27,000. But again, that Tesla trade netted a nice profit. So overall, again, does it suck to stop out? I stopped out down here, right around here. Does it suck to stop out only to see price go up in value, right? Since stopping out, price is up. What is this? Price is up over 20%. Does that suck to see? Of course. But what's to say I didn't stop out and it ended up going much lower, right? That would have turned into a disaster. So, you can't win them all. So this thing is very, very interesting because it just printed the most amount of volume ever, right? If you go on a weekly chart, the volume hit a staggering, what is this? Hit a staggering, call it almost 300 million shares traded last week. The last time it hit that was never, right? In plain English, never got up to that. The previous record was back on 1998, in August of 1998, where it hit 265, 267 million shares transacted in a week. So crazy volume, usually volume like that at tops and bottoms, or form tops and bottoms, as there's a lot of capitulation involved. Let's see where this takes, where this goes next. But definitely a very, very nice bounce to the upside from last week's lows. And that's about it. So if you guys have any questions, feel free to comment down below. If the US 30Y, which is the 30-year government bond year yield, gets above 5%, sustains value, and moves higher, it can act as a headwind for the market. But because TLT has such a crowded short, it should move higher, which takes yields down with it, and as a result acts as a tailwind for the overall market. And hopefully those levels will be helpful going forward. But that's it. Peace.